In today's video, we'll discuss breakout trading. We'll delve into some of the most effective trading tactics employed by professional traders when engaging in breakout trading. Breakout trading stands out as one of our preferred entry strategies when navigating the markets, attributed to its contribution to some of the most substantial gains we've experienced over the years. Throughout this lesson, you'll grasp the ability to recognize the setup, determine optimal entry points, and identify potential targets when implementing breakout trading. Additionally, we'll examine numerous examples across both the 4-hour and daily charts, as these two time frames have proven to yield optimal results for executing this breakout strategy. What is a breakout? Before delving into my preferred breakout trading strategy, it's essential to establish a clear understanding of the term breakout. A breakout refers to any movement in price that extends beyond a predetermined support or resistance level. Such movement can manifest either horizontally or diagonally, contingent upon the underlying price action pattern. To illustrate, let's examine two scenarios depicting one of the prevalent breakout patterns observed in both the forex and stock markets. The initial illustration portrays a bullish breakout pattern. In this illustration, it's evident that the market is trending upward but encounters resistance at a horizontal level. Despite two prior unsuccessful attempts, the market eventually breaches the resistance level. This occurrence signifies a bullish breakout from a significant resistance level. Moving on to the subsequent illustration, we'll explore a bearish breakout scenario. Similar to its bullish counterpart, the bearish breakout involves the market breaking downward this time. Following two unsuccessful attempts, the market eventually breaches the support level, indicating a bearish breakout from a pivotal support level. The significance of these breakouts as a trading strategy lies in their indication of heightened volatility. By patiently awaiting the breach of a key level, traders can capitalize on this increased volatility by aligning themselves with the emerging trend at its inception. This breakout trading strategy, which I've employed for several years, has become my favorite approach due to its reliability and the consistently favorable risk-to-reward ratios it offers. This strategy comprises four key elements. First, support. Second, resistance. Third, breakout. Fourth, retest. Trendline breakout. The only breakout trading strategy you will ever need. This illustration closely resembles the first two illustrations. The main difference here is that instead of having trend lines and horizontal lines, we only have two trend lines. One trend line acts as support while the other acts as resistance. This forms what is known as a wedge. The breakout of this pattern occurs when the market finally breaks out to one side or the other. Although novice traders tend to trade the wedge pattern based on whichever direction the market moves. In other words, they let the market show its ability before considering opening a buy or sell position without analyzing other factors. This is certainly very risky and careless. In fact, the wedge is a continuation pattern of the market trend. Therefore, I tend to trade it based on whichever direction is prevailing when the wedge pattern forms. Now, let's apply this pattern to the chart for further clarification. In this chart, the market is currently in a bearish trend, indicated by the downward slope of the moving average line, and the price is below the moving average line. Another confirming factor is the RSI line being below the 50 level mark, indicating a definitive bearish trend in the market. We observe a robust bearish candle breaking through the support wedge, followed by the RSI line, previously below the 50 level, now descending further, signifying an intensification of the bearish trend. This constitutes a compelling sell signal with a notably high probability of success. The breakout phase provides an opportunity to initiate a short position, with a recommended stop loss positioned above the last swing high or the peak of the moving average line. Setting a target. Now that we've identified entry and stop loss points, let's turn our attention to setting targets. As you may be aware, I advocate for the use of straightforward price action levels, taking profits at prior support or resistance levels. Alternatively, a method favored by professional traders involves establishing a profit target based on the 1-3 risk-to-reward ratio rule. This strategy consistently yields satisfactory results. As observed, the price swiftly descends towards the predetermined profit target. Let's look at the next case. On this chart, the market is currently in a bearish trend as indicated by the downward slope of the moving average line, and the price is below the moving average line. Another confirming factor is the RSI line, which is below the 50 level, indicating a definite bearish trend in the market. We now observe a strong bearish candle breaking through the support wedge, followed by the RSI line, which was previously below the 50 level, now falling further, indicating the intensification of the bearish trend. As always, this is a strong sell signal with a very high probability of success. This breakout phase provides an opportunity to initiate a short position, with the recommended stop loss placed above the last swing high or top of the moving average line. Setting targets. Now that we have identified entry points and stop loss points, let's turn our attention to target setting. As you probably know, I recommend using immediate price action levels, taking profits at previous support or resistance levels. Alternatively, the method preferred by professional traders involves setting a profit target based on the 1-3 risk-to-reward ratio rule. This strategy consistently produces satisfactory results. As observed, the price quickly fell towards the predetermined profit target. Buy signals. Let's look at the next case. On this chart, the market is currently in a bullish trend as indicated by the upward slope of the moving average line, and the price is above the moving average line. Another confirming factor is the RSI line, which is above the 50 level, indicating a definite bullish trend in the market. We now observe a strong bullish candle breaking through the resistance wedge, followed by the RSI line, which was previously above the 50 level, now rising further, indicating an intensification of the bullish trend. As always, this is a strong buy signal with a very high probability of success. This bullish breakout phase provides an opportunity to initiate a long position, with the recommended stop loss placed below the last swing low, or the end of the moving average line. Setting targets. Now that we have identified entry points and stop loss points, let's turn our attention to target setting. As you probably know, I recommend using live price action levels, setting profit targets with reference to previous support or resistance levels. Alternatively, I directly set a profit target based on the 1-3 risk-to-reward ratio rule. This strategy consistently produces satisfactory results. As we observe, the price quickly rises towards the predetermined profit target. Next case. Similar to the previous example, on this chart, the market is currently experiencing a bullish trend, as evidenced by the upward slope of the moving average line, and the price being above the moving average line. Another confirming factor is the RSI line, which is above the 50 level, indicating a clear bullish trend in the market. We observe a robust bullish candle breaking through the resistance wedge, followed by the RSI line, which, previously above the 50 level, is now rising further, indicating a stronger intensification of the bullish trend. Once again, this presents a strong buy signal with a high probability of success. This bullish breakout phase offers an opportunity to initiate a long position, with the recommended stop loss placed below the last swing low, or the end of the moving average line. Setting targets. Now that we have identified entry and stop loss points, let's focus on setting targets. In this scenario, I directly establish a profit target based on the 1-3 risk-to-reward ratio rule. Consistently, this strategy yields satisfactory results. As evidenced, the price quickly surpasses the predetermined profit target. As we've seen in the earlier examples, we can conclude that this is one of the trading strategies that is highly profitable in both the forex and stock markets. You can perform manual analysis of the wedge pattern because it's not difficult to do so. However, in this video, I'm using indicators so that we not only need to concentrate on finding signals that align with our trading rules. If there's a wedge pattern formation that meets our trading rules, then we'll open a position according to the existing trend. And if the wedge pattern formation doesn't meet the trading rules, then we should disregard it for the time being. Certainly, this will simplify our work as we won't be burdened by manual analysis, which although easy to do, can be quite cumbersome when analyzing multiple markets and time frames. So, if you need this setup, I've already provided it in the video description column. I've included a template with the system that you can effortlessly add to your chart, automatically plotting all these indicators accurately. This way, there's no need for any additional hassle. Look for the download link in the description. Frequently asked questions. What is the best breakout strategy? My preferred method for trading breakouts is something simple like a wedge or channel break. However, it's important to note that the best strategy varies from trader to trader. The key is to find a strategy that works best for you and aligns with your trading style and preferences. Are breakout strategies reliable? Breakout strategies can be reliable and highly profitable if executed correctly. However, their reliability may vary depending on various factors such as market conditions, time frame, and individual trading skills. It's essential to develop a trading edge and exercise patience when implementing breakout strategies to increase their reliability and effectiveness. What is the best time frame to trade breakouts? While the best time frame for trading breakouts may vary depending on personal preferences and trading styles, I have found the 4-hour and daily time frames to be particularly effective. These longer time frames often provide clearer breakout signals and reduce the impact of noise in the market. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.